Most new and experienced investors lose money for the exact same reason. Not bad stocks, but avoidable mistakes that eventually compound over time. In fact, the biggest investing losses rarely come from crashes at all. They come from simple decisions that people don't even realize are mistakes. I made these mistakes when I first started investing, and they cost me thousands, and hours of time was completely wasted. In this video, I'm breaking down the 4 most common mistakes I see both beginner and experienced investors make, and how to avoid them before they cost you real money. Plus, at the end of the video, I've put a bonus tip in there, so make sure you watch to the end, because it's a mistake that not many people know, but it does cost you a lot of time. Trading your investing account is something you can easily fall into, and it's a trap that I fell into when I first started investing. Now, this essentially happens when you don't have a long-term plan in place and you haven't written out your goals for at least 3 to 5 years when it comes to investing into certain stocks or ETFs. Now, people essentially get disheartened when the market hasn't played in their favor, and they end up calling tops and bottoms, and fear essentially puts them into positions that they don't necessarily want to be in. This is amplified with social media, because you're advertised a new stock, a new investing platform, a new trend, a new ETF every single day. So if you don't have the right structure in place, it's easy to just start trading your account thinking that you're investing and thinking that you're doing something that's sustainable. And that's what we're aiming for. We're aiming for a sustainable strategy that can last us for the long term, and something that we can stay disciplined and consistent with. Now, it's likely if you're trading your investing account, psychologically you're trying to call the tops and the bottoms, and you're trying to avoid a market crash. And data shows that if you had to just miss 7 of the best 10 days that took place within a bear market, your investing results would have literally got chopped in half through that one decision. Whereas if you had stayed invested, you would have recouped those losses regardless. But psychologically, we don't want to invest when the markets are down, so that's a challenge that you have to come over. It's something that I still find a little bit of a challenge to this day, but because I've got my goals written down, whether the market's up or down for the month, I'm comfortable investing into the ETF or the stock that is within my plan. Now, back in 2023, when I was researching stocks, I eventually found 2 stocks that I thought were valuable, both Microsoft and Google, which I'm still invested in today. Now, naturally, I find a broker, I open an account to buy those certain positions, and that's exactly what I did. But the main mistake that I made there was I opened a general investing account rather than a stocks and shares ISA. And because I hadn't maxed out my ISA for that year, I didn't even know what an ISA was. I opened a general investing account, and those investments now aren't safe within a tax wrapper. So if I go over a certain threshold, then I would have to pay tax, assuming I sell out those positions. And it's something so simple to do. If you're just starting investing, the best thing to do is to open an ISA. Keep your investments tax free at that point. And it's something that if I could obviously go back and I had this video, it's something I would have opened straight away rather than opening a general investing account. So guys, if you're going to start investing into stocks and shares, of course I'm not a financial advisor, but keep them in a tax-free account. Now, over the past decades, investing for retail investors has become more accessible and much cheaper for us to get involved into certain stocks or ETFs, but that still doesn't warrant ignoring fees, as it's very important, because fees will erode your gains over time. The same way, if you notice your phone bill goes up every single year due to inflation, you are going to manage those costs or try and get it reduced by your certain provider. You should have the same mentality when buying a stock or an ETF. You should manage your fees as much as you can, because if you could buy the same ETF at a cheaper rate, why wouldn't you want to do that? It's just a no-brainer. Typically in a fund, you'll pay an ongoing charge fee and a transaction fee, and if you're trading more exotic stocks, for example, maybe stocks that are on different exchanges or stocks that are within different regions as well, then it's likely those fees will be a little bit higher, as they'll be seen more exotic compared to investing in an S&P 500 fund, which is obviously based in the US. Some instruments will have bid and ask spreads. Obviously you'll have FX fees if you're buying US or European companies, assuming that you're based in the UK. Commissions to trade if you was to trade CFDs, but we're not really focused on that on this channel. But if you was to do that, then you would have to pay a commission there, and the fund manager still needs to be paid. So that's where that ongoing charge fee comes from, because the person who's managing those funds has to be paid out as well. That's how a lot of these providers make most of their money. It's the fees that come with purchasing the products. Now, you need to understand your investing personality. Are you somebody that likes volatility? Do you like risk? Do you have the stomach for the risk? Can you see your portfolio go minus 20% in drawdown, for example? This is so important because if you don't understand your risk tolerance, then you may be invested into certain stocks or funds that are high volatility and will go down a lot in value over the past year. So you have to have the stomach for that. If you're an investor that doesn't like risk at all, maybe stocks isn't for you. Maybe you should invest in bonds or real estate trusts, for example, or dividend paying stocks that are more consistent in terms of paying you quarterly, for example. So understanding what you're looking for out of a stock is so important. There's no point buying an Nvidia stock if you can't handle the fact it might go 10%, or if you're buying Tesla, you can't handle a 20% drawdown. So you need to understand your risk tolerance. Simple ways you can do this is by searching up the beta of a certain stock. If the beta is higher than 1, it's more volatile. If the beta is lower than 1, it's less volatile, in simple terms. But if you wanted a deeper video on this, let me know and I can show you what stocks are higher risk just by looking at certain metrics as well. Personally, as an investor who dollar cost averages every month, I have a set amount that I'm going to invest for the month, and I don't invest more than I can afford, because when you're looking at past performance, although it doesn't indicate future returns, you could fall into the trap of thinking the market's going to go up forever and you end up investing more than you can afford. Now, it's a slippery slope because we don't know what the market's essentially going to do. And if you're saving up for something like a house or a new car or something big, you don't want that money tied up into markets because, again, markets go up and down. So understanding how much you're comfortable with investing every month is something so simple to do, and especially if you write it down within your overall investing plan. Psychologically as well, you'll be able to sleep at night not worrying about the market or something that you can't even control. So it will stop you from constantly looking at your investing app, and it will just put ease of mind, which is something that can be overlooked, but it's something that's very, very important, especially if you're investing over a long period of time. Famous investor Peter Lynch once said, people go to the library and they do incredible research on a microwave oven, but they'll put $5,000 or even $10,000 on some random idea they heard on a bus. That's gambling. That's not investing. And it still holds true to this day. This is caused by taking recommendations blindly. I know we all have that one friend who goes on about a certain stock that they found on Instagram or Reddit or TikTok, for example, that is just going to go to the moon. I mean, we've seen a lot happen with crypto and meme coins and how they're hyped up, and we can easily fall into the trap of taking recommendations blindly because somebody has told us to have a look at something, right? This is called authority bias, bandwagon bias, or just broadly speaking social proof, sheep mentality, right? So important to get out of that mind frame of thinking like that and also taking everything as they are, right? Have a look at a stock for yourself. Have a look at the financials, look at the sentiment around that stock, and look at the investor relations page on their website, because that page will literally tell you the goals of the company and what they're building for the future. Doing research on a stock will allow you to figure out the rough drawdown periods of that stock, the typical returns of that stock, if they pay a dividend, if they don't pay a dividend or not. It will just allow you to be much more prepared once you're in that position. Even things like seasonality, for example, Q4 in October and December is typically when Amazon sees most of its gains, most of its revenue and earnings, mainly due to obviously Christmas. There's Thanksgiving as well, the overall holiday season, people are spending a lot more money. Now, if you didn't look at the investor relations page or look at the financials, for example, you wouldn't know that this is a common occurrence. So you'd be surprised if you saw a massive spike in Amazon come Q1. Investing in its raw terms is simple. Have a plan, draft it out, stick to the plan, look at the stocks that you're invested in and be consistent. It's our own minds and our own psychology that makes it a challenge. You know, when you're looking at a new stock that's overhyped, you can get funneled into that process, even though it may not be the right stock for you, but you want to get involved because it looks like everybody else's. And it's about having the discipline to stay away from that stock for the moment, or if you are convicted on it and you've looked at it, having essentially the gut and the stomach to get involved in that position. We as people also think that maybe we can time the market, time the tops and the bottoms of the market, but none of that actually matters, because if you stay invested over the long term, your results will average out rather than trying to pick the tops and the bottoms and potentially missing a bull market in that process. This is why most people lose when it comes to investing. It's our own thoughts and psychology going into the market, thinking that we can pick certain tops and bottoms, thinking we can outsmart the market, and not being patient enough to allow compounding occur. So if you take anything from this video, write down a plan and a strategy for at least 6 to 12 months and evaluate that over time. But the most important thing for me at this moment is to stay consistent investing into the market and allowing compounding to affect over time. So not selling out and getting panic sold out of positions, even if we are in a bear market. So if you enjoyed that video, guys, let me know your thoughts in the comments, leave me a like, and I'll see you on the next one.